A pump and dump scam is a type of investment fraud. It involves artificially inflating the price of a stock through false or misleading statements. This scam is often orchestrated by a group of individuals who already hold a significant amount of the stock. They spread positive rumors and hype about the stock to attract unsuspecting investors. Scammers artificially inflate the price of a stock. They use various methods to create a buzz around the stock, such as social media posts, online forums, and even fake news articles. The goal is to create a buying frenzy that drives up the stock's price. They do this through misleading positive statements. These statements are designed to make the stock appear more valuable than it actually is. The scammers might claim that the company is about to release a groundbreaking product, or that it has secured a lucrative contract. This is the pump phase. During this phase, the stock's price rises rapidly as more and more investors buy into the hype. The scammers continue to promote the stock aggressively to keep the momentum going. They then sell their shares at the inflated price. This is known as dumping the stock. The scammers sell off their shares at the peak price, making a substantial profit. Unsuspecting investors are left holding the stock as the price crashes. Once the scammers have sold their shares, the stock's price plummets. The investors who bought in during the pump phase are left with worthless shares. This is the dump phase. The rapid decline in the stock's price can happen within minutes or hours, leaving investors with significant losses. These scams often target penny stocks. Penny stocks are shares of small companies that trade at low prices. They are more susceptible to manipulation because they have low trading volumes and are not closely monitored by regulators. Penny stocks are low-priced shares of small companies. These stocks are often traded over the counter rather than on major stock exchanges, making them easier targets for scammers. They are more easily manipulated due to their low trading volume. The low volume means that even small trades can have a significant impact on the stock's price. However, pump and dump schemes can target any security. While penny stocks are common targets, scammers can also manipulate other types of securities, including cryptocurrencies and larger stocks. Investors lose significant money in these scams. The financial losses can be devastating, especially for those who invested a large portion of their savings. It is crucial to understand the mechanics of pump and dump schemes. By educating yourself about how these scams work, you can better protect your investments. Recognizing the warning signs is essential to protect your investments. Be wary of unsolicited stock tips, especially those that promise high returns with little risk. Always do your own research before making any investment decisions. The first stage involves the pump. Scammers spread false or misleading information. They may use online forums, social media, or email. The goal is to create hype and drive up the stock price. Unsuspecting investors see the stock price rising. They believe the hype and buy the stock. This fuels the artificial price increase. The scammers, who hold a large number of shares, sell their stock at the inflated price. This is the dump phase. The stock price then plummets, leaving investors with significant losses. Be wary of unsolicited stock tips, especially from unknown sources. Exercise caution with promises of guaranteed returns. No legitimate investment guarantees profits. Beware of stocks with sudden and unexplained price surges. Look out for unusually high trading volume, especially in illiquid stocks. Be skeptical of overly promotional language or exaggerated claims. If it sounds too good to be true, it probably is. Conduct thorough research before investing in any stock. Rely on credible financial information sources. Avoid relying solely on social media or online forums. Be cautious of penny stocks or companies with little to no track record. Understand the risks associated with investing in such companies. Diversify your portfolio. Don't put all your eggs in one basket, especially not in a single, volatile stock. If an investment opportunity creates a sense of urgency, take a step back and evaluate it carefully. Social media platforms have become breeding grounds for pump and dump schemes. The speed and reach of social media allow scammers to spread misinformation rapidly. Scammers create fake profiles to build credibility. They use bots to amplify their messages and create artificial hype. They often target inexperienced investors who are active on social media. Be wary of investment advice from unfamiliar accounts on social media. Verify the credibility of sources before acting on any stock tips shared on these platforms. Section 6. Regulatory measures and enforcement. Regulatory bodies like the Securities and Exchange Commission or the SEC are cracking down on pump and dump schemes. These schemes involve artificially inflating the price of a stock through false or misleading statements, only to sell off shares once the price has been driven up, leaving unsuspecting investors with significant losses. The SEC has brought numerous enforcement actions against individuals and entities involved in these scams. These actions range from hefty fines to criminal charges, aiming to hold perpetrators accountable and send a strong message to the market. The SEC's efforts are part of a broader strategy to maintain market integrity and protect investors from fraudulent activities. These actions serve as a deterrent and highlight the illegality of market manipulation. By taking legal action, the SEC not only punishes wrongdoers, but also educates the public about the risks associated with such schemes. This dual approach helps to foster a more transparent and fair trading environment. However, the decentralized nature of the internet and the speed at which these schemes operate make enforcement challenging. Social media platforms and online forums can quickly spread misinformation, making it difficult for regulators to keep up. Despite these challenges, the SEC continues to adapt its strategies to better monitor and address these evolving threats. Investors should be aware that regulatory measures alone cannot prevent all pump and dump scams. It's essential for investors to conduct their own due diligence and be skeptical of unsolicited stock tips, especially those that promise high returns with little risk. Understanding the fundamentals of the companies they invest in can help mitigate the risk of falling victim to these schemes. Staying informed and vigilant is crucial to protect your investments. By keeping up with the latest news and regulatory updates, investors can better navigate the complexities of the market. Remember, a well-informed investor is a well-protected investor. Always be cautious and seek professional advice when in doubt. Section 7. Real-world examples of pump and dump scams. In 2018, the SEC charged individuals for orchestrating a multi-million-dollar pump and dump scheme using social media. This case was a significant example of how modern technology and social media platforms can be exploited to manipulate stock prices. The individuals involved used their influence to create a false sense of excitement and urgency around a particular stock, driving up its price artificially. They promoted a penny stock as a marijuana stock despite the company having no involvement in the cannabis industry. By leveraging the growing interest in the cannabis sector, they were able to attract a large number of unsuspecting investors. These investors, lured by the promise of quick profits, bought into the stock, causing its price to skyrocket. This case demonstrates the manipulative tactics used by scammers. They often rely on misinformation and hype to create a buying frenzy. Once the stock price reaches a certain level, the scammers sell off their shares at a profit, leaving the new investors with significant losses when the stock price inevitably crashes. It highlights the need for investors to be skeptical of hyped-up claims, especially in volatile sectors. Investors should always conduct their own research and be wary of stocks that are being heavily promoted without substantial evidence to back up the claims. Due diligence is crucial in avoiding such traps. Numerous other pump and dump schemes have been identified and prosecuted. These schemes often follow a similar pattern, with scammers using various platforms to spread false information and create artificial demand for a stock. Law enforcement agencies and regulatory bodies are continually working to identify and shut down these operations. These cases serve as reminders of the risks involved in the stock market and the importance of investor education. By understanding the tactics used by scammers and staying informed about market trends, investors can better protect themselves from falling victim to such schemes. Education and awareness are key to navigating the complexities of the stock market safely. Section 8. The importance of due diligence and research. Due diligence is crucial before making any investment decisions. Research the company, its financials, and its management team. Use reputable sources of financial information. Understand the company's business model and its competitive landscape. Analyze its financial statements including revenue, profits, and debt levels. Don't solely rely on stock tips or recommendations. Conduct your own research to make informed investment choices. Section 9. Protecting yourself. A call to action. Protecting yourself from pump and dump scams requires vigilance and education. Be wary of unsolicited stock tips and promises of guaranteed returns. Conduct thorough research, rely on credible sources, and diversify your portfolio. Be skeptical of information on social media and be aware of the tactics used by scammers. By staying informed and exercising caution, you can protect yourself from becoming a victim of these fraudulent schemes.